Hey, welcome to the weekly option. This is your host, Eric, and I wanted to make a quick video to discuss the trades from the most recent episode 166, recorded on May the 14th, 2021. And before we get this going, if you haven't already subscribed to this YouTube channel, please do subscribe. I'm adding more content and trying to get just grow my listens and grow the podcast this year. So thank you for all your support. Love all you guys. Thank you for the email as well. Let's dive into the video. So for our first trade this week, we're looking at a covered call on Curis Inc., symbol CRIS. That is C as in Charles, R as in Romeo, I as in India, S as in Sierra. Here's a chart from it. And we can pull it back quite a ways just to get a better sense of where this has been. And this view right here is why I do actually have hope for this chart. So you can see how we have already pulled back and gone quite a bit lower. We actually did end up breaking that trajectory most recently after the strong earnings that they had back in November. And let me get rid of this before we get going. And it seems to be trying to create a new, certainly this gap move, get rid of the volume too. This gap is huge, and it seems to be trying to create a nice new, a nice expanded upward swing. Now, this is also a little bit of a tale of caution because I constantly am looking for sideways movement. I want to make sure that I don't get trapped into that. But look at this bar that came on earnings. So here's why I like this trade overall. If we have indeed, so if you look at the last earnings that got a nice push, but then this recent earnings got a large pop. If we were to go ahead and assume that this is going to stay in this region, then I actually like this trade for a couple reasons. So let's look at the option string. This is for the June 18th expiration day. If we sell the 15 strike, we're going to sell it at $1.65. You can always put a limit order at 170 or 175. It works out either way. I like taking in 10% of the strike and premium, so that if we do get a rise higher to $15, which is, by the way, we were higher than that just a few days ago. So I think we could ultimately end up returning to that over the next 5 weeks. But if we do, not only do we get to keep this $1.65 either way, but we also get the difference between the strikes. So right now, stock is trading for $13.57. With this $15 strike, you're looking at picking up another $1.43 in addition to this $1.65. So that's how you end up getting such a high return on such a low stock. So that was our trade number one. Trade number two was a credit spread on the EEM. That is the MSCI Emerging Markets ETF. So let's go ahead and take a look at that. And, this has been also a very nice, ultimately a nice little, well, really, I don't even need to do that. I'm going to delete this and start over. Sometimes you got to do that, friend. Sorry. Because we have different trajectories that occurred that are worth noting. All right. So you had these, and you currently have kind of this sideways one. And I am looking at, where might this head? I like the fact that it's had strength since, it's had lots of strength along with the market. This is essentially trading the market. There's a high correlation to the S&P and the Dow. Obviously, because of the interaction with global markets. So that's probably a better way to say it. There's a high correlation with global markets, with these emerging markets. Normally, they do outperform more traditional markets, but in periods where the money is really flowing in traditional markets, they don't always outperform. So I'm looking at let's go ahead and open this one up, and we'll make sure we choose the correct June. So looking at selling this June 53-54 call spread, this pattern here, this sideways, is actually pretty damaging, and I think it's most likely going to head lower, or it may end up. I mean, we could head higher. That's the reason why I like looking at these spreads and really pricing them out, and collecting. Selling the May 53 call at 104, and then buying the May 54. I'm sorry, I said May. I need to move forward. June is where we're looking. So selling the June 53 call at 104, and then buying the June 54 call for 67 cents gives us a spread value, right? A spread value of like 37 cents. That's huge on a $1 wide call spread. So I like this trade. I like the odds of making money. I'm ultimately in making this trade, ultimately saying, we've had sideways markets for the last couple months, and I'm kind of expecting those markets to continue or possibly head lower, because ultimately our strikes are basically right in here, right in this range, and I'm essentially saying I think we're going to go lower. If price does go higher, then I'm probably going to look to sell like the 52-51 put spread against it, something along those lines, or maybe even the 51.50, just to give us a little bit more cushion. So that's it right now. I'm looking at selling this June 53-54 call spread at 37 cents. And then our final trade is going to be, let me pull this on back out, get rid of these channels. I love seeing these channels, by the way. They have helped me make decent money in the past, and have kept me from losing money as well, because God knows that can happen just as easily sometimes. So AMC, looking at a debit spread in AMC, and there's a lot that I like about AMC. I like the fact that it had this high price. We came on off, we pulled higher, we pulled back, and we're kind of back in that range right now. This thing could end up popping all the way back to 20. But let's look at the options, and I'll show you what I liked. I liked a few things about AMC, but I was only able to choose one for the show. So let's see. Oh, I've got a resting order out there. There are a lot of interesting price dynamics going on here. For instance, you could look at this June 12, 13, right? With stock sitting right at 13. You could actually pay 45 cents for that, but that's not the one I showed on the show. On the show, I pointed out that I did make the mention that there's some other trades around it that are very interesting, like this June 10, 11. These are in the money calls. This call spread right now, if you were to pay $3.85 and sell the 11 call at $3.30, that's 55 cents, right? So for the 12-13, you've got 45 cents. 10-11, you've got 55 cents. But for the 11-12, which is the first in the money, closest to the strike in the money spread, that is trading for about 67 cents, right? If I do the math correctly, 67 cents, because you're paying $3.35 for the June 11 call, selling the June 12 at $2.68. This trade is already $1 in the money, because the underlying is $12.98. So paying 67 cents, being able to make 33 cents on this trade in the next 5 cents is a great return on your money. So that's the reason I like this. And if we just look right now, basically I'm saying I expect prices to finish at least $12 or higher in the next 5 weeks. Sure, we could get a pullback, and I know exactly what my low end risk is, but I like that we've had this push higher, and the hope is that it's going to push higher once again, maybe come on back down and push higher. So I like these trades. I like this stock. This stock still has a lot of people looking at it, a lot of opportunity, and I prefer to play it in options with limited capital rather than playing it with the actual underlying. So that's it for the trades presented on this week's show. Like I said, if you haven't already subscribed to the channel, please do hit the subscribe button on YouTube as well. And thank you so much for listening. As always, happy trading.